Now, our entire discussion will be on this output, that is aggregate output, and the price level. Basically, that's inflation. So what happens when there is increase in the demand, when there is decrease in the demand, increase in supply and decrease in supply, and its effect on the price level and the output? That is what our focus is going to be. So we will first discuss everything from the aggregate demand point of view. Demand basically of an individual, we've learned that in microeconomics. Aggregate demand is the demand of entire economy. And then the aggregate supply, which is the supply of the entire economy. So we will focus on individually, and then we will see the connection of it, the shift in that demand and supply, and what is its effect on the price level and the output. That's going to be our focus for the next couple of hours or so. Okay. So what is aggregate demand? As I said, from individual, we now move to aggregate. It represents the quantity of goods and services that everyone, that is households, government, businesses, want to buy at a particular point of time or at a particular price. So that's the aggregate demand, the demand from everyone's point of view. How much is the economy willing to buy? Clear? Then if you see on the same way, aggregate supply will be the amount of goods and services that the producers are willing to sell at a particular price. So in both the cases, you will notice that for a particular price level, what is the quantity of goods that, quantity of goods that everyone is willing to buy, that is aggregate demand, and what is the quantity of good that the producers are willing to sell, that is called aggregate supply. Is that clear? Now we are going to understand in much detail about aggregate demand and supply. But right now we will focus on first demand, aggregate demand. We'll come to aggregate supply later on. So tell me one thing, why would someone demand? Well, in what case there will be increase in the demand in the country? When there is an increase in demand, what will happen to the output? If there is an increase in demand, the aggregate output, which means GDP of the economy, will increase. So we need to see what are the components which will lead to increase in the GDP or increase in the demand. Well, they are the same, C plus I plus G plus X minus M. So to derive aggregate demand, we need to understand the factors that determine each of the component of GDP. Are you getting it? Why am I focusing on GDP's components to understand aggregate demand? Because, well, the GDP will increase because of its component, and that's what will happen when there is an increase in the demand. Clear?
Yes.
So consumption, first, let's focus on every part. Consumption, it is a function of disposable income, means how much of the income is available in my hand after taxes, right? If there is an increase in personal income or decrease in taxes, what will happen? My consumption and savings both will increase. That means I will be able to spend more, isn't it?
Yes.
The proportion of additional income spent on consumption and the proportion of additional income spent on savings means, let's say today you are earning $1,000. Next month you may make $1,100. So how much have you earned extra? 100. Out of that 100 additional that you have earned, how much you spend on consuming or savings? Let's say out of that $100 you spend $60 on some consumption. That is called marginal propensity to consume. And the $40 that you spend on savings, that is called marginal propensity to save. So what do you do with that extra $100? Either you
consume or save.
That's called marginal propensity to consume or marginal propensity to save, which both should be equal to 100%, isn't it? Correct? Yes. Understood or not understood? Please,
Yes.
please let me know so that I can move, because the topics are very lengthy.
Yes.
If not, do ask me, okay? So what is marginal propensity to consume? Means how much of the proportion of additional income you are consuming or you're saving. The more and more you are able to do that, right? The more and more you are able to consume, the more will be the C factor, the C, consumption. Then comes investment by the business and individuals. It depends on how much profits you are making. If you are expected to get better returns, you will invest more. That's the logic, right? So it is a function of expected profitability and the cost of financing. If your profitability is more than the borrowing cost, basically your equity returns are more than borrowing, then definitely companies or individuals will invest more into the business. If the expected profit here, the expected profitability depends on the overall economic output or economic level. Financing costs are reflected in real interest rates. So if the real interest rates are keeping on increasing, it's more and more difficult for you to generate profits, right? And we know what is real interest rate. It's nominal minus inflation. So after C, C is dependent on marginal propensity to consume by individuals and everyone. I is investments, which is dependent on expected profitability and the cost of financing. Clear?
Yes.
G, government. Government does what? Government spends and government earns. Now, government earns from taxes. And tell me one thing, government will make more taxes when the economic output is good or bad?
Good.
It's good. It's booming, right? So
Yes.
government taxes or tax revenues are dependent on economic level, correct? Economic activity, right?
Yes.
But remember one thing, government spending or what government purchases or invests, that is not related always to the economic activity. Why? Because governments do spend more even when the economic activities are good or bad. So government purchases may be viewed independent of economic activity, but tax revenue is not independent. So based on how the economy is performing, government still do some activities, right? Whether the economy is doing good or bad, it does spend on police, it does spend on defense, it does spend on basic infrastructure. Clear? But
Yes.
the tax revenue is definitely dependent on the economic activity. Clear? Yes. And
Yes.
net exports, that is exports minus imports. When will you import more? When people in your country have more money, they will import more, right? And people in foreign country, when they have more money, they will import from there, means you will export more. Clear?
Yes.
So net exports are a function of domestic disposable income, means more domestic income, more imports, or foreign disposable income, means if foreigners have more money, then your exports will be high. Clear?
Yes.
So what do we notice here overall? What is the situation? The aggregate demand curve, the demand by the industry, the demand, by the way, demand was dependent on price. It was a graph of price and quantity, right?
Yes.
So here, price level of the entire economy, sorry, and the quantity of the entire economy. Here you can, just for your reference, you can say price level can be anything. The price in the economy can be inflation or interest rates. Interest rate or inflation, whatever you want to assume. And income or output is nothing but your GDP. Okay. What do you notice from this diagram? What is happening? The aggregate demand curve is upward sloping, downward sloping. Like any other,
Upward.
it is downward sloping, isn't it?
Downward sloping.
So the lower the price, more will be the quantity demanded, isn't it? Clear? That's what the natural thing is. So AD curve, like any other ordinary demand curve, shows that quantity of real output demanded at different price level is due to the two conditions. Two conditions must be satisfied. First of all, it is a downward sloping curve, right?
Yes.
That at for more and more output, the price reduces, or I can say at higher level of prices, lesser and lesser output is there. Clear?
Yes.
Now this demand curve, very, very important thing. To get this demand curve, there are two conditions which must be satisfied, which will be the most important thing for us discussion, for our discussions going ahead. That First, what was the GDP equation? Aggregate income and planned expenditure must be balanced. S minus I should be equal to fiscal balance and trade balance. You remember
Trade
that?
balance. Yes.
Correct. So what does this mean? Two conditions should be met. Why? I'll read that. The AD curve, like an ordinary demand curve, which shows that the quantity of real output demanded at different price level, provided two conditions are satisfied. First is this: aggregate income equals to planned expenditure, which I will write is, can you tell me the equation? S minus I equals to
G minus T
E and
plus X minus M.
X minus M. Correct. So it's a combination of what? Two things. Combination of two things. Your savings minus investment is a combination of two things: your trade balance and your fiscal balance. That is, the first condition should be met. And the second condition that we are going to focus on is the equilibrium in money market. Now, money market is a market for borrowing and lending, which will decide what will be the interest rates and what will be the money supplied at that interest rate. So we will look at these two important factors and then come back to what exactly aggregate demand tells us. So now I'm going to discuss, it's a continuation, by the way. I'm going to discuss in detail what is the ISLM curve. First of all, we just discussed the equation S minus I equals to fiscal and trade balance, right?
Yes.
When put together the IS and LM curve, we get the AD curve. So to get the aggregate demand curve, you need to combine two things. What? The IS
and
and
LM
the
curve.
LM curve. Now, when I say IS, it is dependent on income and savings, which is the first part here, S and I. And when I say LM, LM is the curve which is for liquidity and money, which is the money supply, basically related to the money supply. Okay. Now we will discuss both of that. First, when I am discussing on the IS curve, the income and savings. So we know aggregate income should be equal to planned expenditure and all, right? Now just notice one very, very, very important thing here. It illustrates the negative relationship between real interest rates and real income. So what does it mean? That there is a negative relation between interest rates
And the real income.
Income, that is the money left with you, real money left with you. For equilibrium in which market? Goods market. Goods market. Goods market means basically buying and selling of goods and services. What does it tell? First of all, there's a negative relation. Whenever there is a negative relation, it's downward sloping or upward sloping?
Downward.
Downward sloping. So check your real interest rates and real income is downward sloping. Now, before I read anything, what is happening here? That when your interest rates are rising, your real income is reducing, right? Or I can say when interest rates are falling, your real income is
Increasing.
increasing. Remember this. Now let's understand this. The point on the IS curves are combinations of real interest rates and income consistent with the equilibrium in the goods market. When lower interest rate, what is the meaning basically of all this? When interest rates are low, tell me one thing, if your bank offers you lower interest rates, will you save more or you'll invest more? Think from the economy point of view. When the interest rates are at 1%, will people deposit more money in the banks or people will borrow more?
Borrow.
So now, if interest rates are low, tell me what happens to this equation of S minus I. Will there be more savings or more investments?
More investments.
So can I say S minus I will be less than G minus T and X minus M? Why? Because investments will be more than savings, isn't it?
Yes.
This will happen when the interest rates are
Down.
So at lower interest rates, what will happen? There will be decrease in savings in the favor of consumption and tend to increase investment by firms. Because more investments will have lower interest rate, your NPVs will be positive, your projects will be more profitable, your cost of capital will be low, and therefore businesses will invest more. Therefore, a decrease in interest rate decreases S minus I, correct? If you see that equation, what happened? Our S minus I will decrease. And now we know that they both should balance, right? So to balance, what will I have to do? S minus I has reduced. What will I have to do? I will have to reduce the other equation, which is the fiscal and the trade balance, right?
Yes.
That equation go down. How will that right hand side part go down?
T should be more than G.
Yes. So can I say I should raise taxes?
Taxes, yes.
Or there should be more imports.
Imports.
Clear. So now read this. What happens? Now see the scenario. Lower interest rate happened. So savings were less, investments were more, S minus I was less. But in order to satisfy the relationship, income must increase, and which means greater income can restore equilibrium by increasing savings. Either your savings should be increased on the left hand side, correct? Or what should happen? Your taxes should increase or your import should increase. So to rebalance again, you will have to increase taxes or imports or more savings. Clear? Only then the situation will be balanced. So what happens? The conclusion is that whenever the interest rates are falling, the real money in the hands of people, the real income is, interest rates are falling, the real income is
Increasing.
Now, when the real income is increasing, when people have more money, they will invest more. And with that, the tax revenues can be increased because there will be more profits. And with that more money, you can also increase the imports. So the reaction is that when the interest rates are down, there can be more taxes and more foreign goods buying. Clear?
Yes.
So the lower interest rates will increase more money in the hands of people. Clear? That is the IS curve. Right?
Yes.
Now understand the LM curve. LM curve is the liquidity in the economy. Now the IS curve denoted as the negative relationship between real interest rate and income, right? Contrary to that, LM curve discloses the positive relationship between real interest rate and real income, but consistent with the equilibrium in the money market. There it was goods market. Now here it is money market. What is money market? Borrowing and lending market for short-term funds, right?
Short-term, yes.
Now think of that. If the interest rates are high in the money market, what will happen? If the interest rates are high in the money market, what will happen? People will do what? Will they demand more money or less money when interest rates are high?
Less money.
Less money. So higher interest rate decreases the quantity of real money balances that individuals want to hold. Now this is very interesting. You will not keep more and more money with you. Why? So for a given real money supply, equilibrium in the market requires that an increase in real interest rates to be accompanied by increase in real income. What does it mean? Any idea? What has happened when there was high interest rates? When the interest rates were very high, keeping money with you does not make sense. So why? Because the interest rates are also increasing. So the real interest rates will increase when interest rates are high. What will happen along with that?
We'll do more investments and we will.
Your income should also increase.
Savings and increase the interest income.
Correct. So basically, if there is too much of high interest rates in the money market, I will have to generate more and more profits. Basically, I'll have to generate more and more income to compensate that. So the increase in demand for money from an increase in income can offset the decrease in demand for money. Hold on, very important. Increase in demand for money due to my income has increased. So because my income increased, the demand for money also increased, right? But this should offset with what? Decrease in demand for money from a higher real interest rates and restore the equilibrium in the money market. Now that may sound very, very confusing, but read it again. The increase in demand for money due to increasing in income, because my income has increased, my demand for money has increased, will exactly offset what? That when higher interest rates are there, people will not actually demand more money. They will actually demand less money. So when income is increasing, what will happen? Money demand will increase. But that will lead to higher interest rates. So higher interest rates will do what? They will
Decrease.
reduce the demand for money. So when income is increasing, the money demand actually should increase, but due to higher interest rates, what will happen? The money demand will fall. So who supplies the money? The money market. And the money market has a positive relationship. So the more and more real interest rates, the more people are willing to supply money more rather than demand money, because it's costly to borrow. Clear? I'll repeat. When the demand will be less, but people are willing to supply more and more when the interest rates are high. So in the money market, what will you see when the interest rates are high? There will be
Decrease in the money.
Decrease in the demand, but
Demand.
more increase in the supply of money. Clear? So at higher interest rates, you want more and more money to be not held by you, but to be supplied or invest. Now again, what does this both mean? When you combine both, you get to know the demand for money and the supply for money, and that will define two important things: the interest rates and the real income. So we know that the aggregate demand for money, which is the IS curve, is downward sloping and the supply is upward sloping, right? So where demand and supply meet, what happens? You get the price and the quantity. So what about the point below this, which is on the left hand side? What is the situation? Here the demand for money is high, but the supply is less. Clear? Isn't it? So tell me one thing, when the demand for money is higher than the supply, what will happen to the interest rates?
It will reduce.
Listen to my question clearly. When the demand for money is high, but the supply is less. For example, let's say we are demanding more and more goods, but we don't have enough money. The money is less. What will happen to the interest rates? People will borrow more or invest more?
Increase.
This is what will happen at this situation. At this point, what happens? The interest rates will be high and the real income will be low because the demand is more than the supply. On the other hand, if you look at the lower point, if you look at the point on the right hand side, there is more money supply in the economy than the demand. So what is that point where both intersect? Well, that is what the IS and LM curve importance is, that what should be the interest rates and the real income? They should be at a point where the demand and supply intersect, where the demand for the aggregate demand for goods and services, basically that is the IS curve, meets the LM curve, the money market equilibrium. This is the point where interest rates and income will connect. So what exactly, why did we learn IS and LM curve? For overall equilibrium, the values of real interest rates and income must be consistent with the equilibrium in both goods and money market. Means your demand for goods and services will be very much dependent on what happens in the money market. Clear? So if there is enough of liquidity in the economy, now what does this all mean? That when government wants to boost the economy, what should they do? They should do something in the money market, right?
Yes.
So if I want more and more people to buy goods and services, should I reduce the price or increase the price? I mean, should I reduce
the price.
interest rates? That's
Yes,
how
yes.
there will be more demand in the goods market. Clear?
Yes.
This is what governments do, right? When they want to boost the GDP, they increase the interest rates or reduce the interest rates through the monetary policy. Reduce the interest rates. Are you getting it?
Yes.
So the conclusion is that when the governments want to increase the to maintain the equilibrium in the goods market, there should be equilibrium in the money market. Basically, that's what IS and LM curve tells us. So the conclusion is that to boost the economy, the government will have to reduce the interest rate or vice versa. If there's too much of borrowing and lending in the economy, if there is too much of money in the economy, then there is high inflation, and then government increases the interest rate so that inflation is controlled. Now, all this we will learn in the monetary and fiscal policy in the next section, also in the next reading, also next to next reading. But here is the highlight of that based on what happens in the goods market, what happens in the money market, they both are connected, and that's what defines what should be the real interest rates. Clear? You have to read it once again to understand the equilibrium. But will it always remain the same? The situation, will it always remain the same as what it looks like?
No.
There will be increase in demand, the shift in demand, there will be increase in supply and all. So basically our objective is that what happens when there is a shift in all these things. So now I move towards an important element where we combine the IS and LM curve. The LM curve basically focuses on the money supply in the economy. The money supply. Who supplies the money? Well, the government also intervenes that through the banking and the financial system. It supplies more and more money in the economy so that the economy boosts, or at times it pulls out money from the economy to control the inflation. That's what governments do through monetary policy. Now, how is that done? See here. The supply curve is normally upward sloping, the LM curve. Here you see multiple LM curves. What is marginal propensity, by the way? Is a proportion of money that you spend, right?
Yes.
We discussed MPC and MP as marginal propensity to consume and save. So LM curve is drawn for a given level of real money supply. Holding the nominal money supply constant, an increase in the price level means inflation decreases the real money supply and vice versa. Means nominally I am not increasing any money supply. The government is not giving more and more money. The nominal money supply is constant. But if the price level, which means you can say inflation, if the inflation is increasing, the real money in the hands of people will be more or less?
Less.
Let's say everyone has $100 in the economy. But if the price level or inflation is increasing, we all will be able to buy less things from the same $100.
Yes.
Correct? Therefore, an increase in the real money supply, if I increase the money supply, it will shift the LM curve downwards. So what happens? The LM curve goes downwards. So just notice here, let's say this was the situation. Okay. Now, when I increase the money supply, what happens if the money supply has increased? So the LM curve, they are saying, has gone downwards. So with that, what happens? Because an increase in the real money supply shifts the LM curve downward, we can identify different combinations of income and real interest rates consistent with the equilibrium for a different price level. Basically, what it means, a greater real money supply reduces equilibrium real interest rates and shifts the LM curve. Means, so now if I increase the money supply, what has happened? See now, the point becomes here. This is the new LM curve which connects to the real income. So initially, let's say the real interests were at this point. Now they will become at this point lower interest rates, right? So when I increase the supply at the same demand, when I increase the supply, what will happen? Prices will, the natural thing, prices will
Reduce.
Prices will go down, right? So your interest level will go down.
Go down.
If I increase the supply of money, and that's what happens with more and more, more and more money being supplied. So the conclusion is that if the real money supply is increased, the interest rates will come down. The price level will come down. Okay. Now, if I plot the aggregate demand curve on this, so now what we have done is that at different LM curves, at different money supply, we plot the demand curve, the aggregate demand, which is the amount of goods and services people will buy for. So here, if you noticed, at the basic point, at point B, this is where both my IS and LM curve combine. So this is the price level and this is the real income. But when there is more money supply, what happens? The real interest rate goes down and the income increases, isn't it?
Yes.
So at the same demand curve, if I increase the supply, the real interest rates will go down and the income will increase, isn't it? So now see this. This is the downward sloping relation between price level and real income. Now, I just want you to read this to understand why is this downward sloping and what does it mean basically. So what exactly does it mean? That what happens when there is more and more money supply in the economy, what happens to the overall prices and the real income in the hand of people? Yeah, can you just read what happens from point A to B to C?
Point A is on an LM curve for a lower real money supply than point B.
So at point A, the money supply is relatively less. When I increase the money supply, it goes downward. Correct? That LM curve goes on right, downward. Okay. So what is point C on LM curve? For higher money supply.
Higher real.
Correct. Now, after that, as a result, the relationship between price level and real income, given that the income is equal to planned expenditure and money is what? Downward sloping. Anyways, so the relationship between price level and real income is downward sloping. Means whenever the price level comes down, the real income in the hands of people increase. That's the conclusion of ISLM curve. The conclusion of ISLM curve is that when the real interest rates are, there is an inverse relationship between the interest rates and the real income. So the more and more money is supplied, the higher LM curve which shifts on the right, the lower will be the real interest rates and more will be the real income. So why exactly it is downward sloping? Because higher price levels, at higher price levels, what will happen? The wealth will be reduced. There will be more increase in the interest rates, and which will make domestically produced goods more expensive compared to goods abroad. So when when aggregate demand curve slopes downward, because when the prices are high, we are left with less money in our hands. Interest rates are increasing in the economy. The goods have become more costlier in your economy. So it's better to buy from abroad, right? All of which will reduce the quantity of domestic output demanded. Conclusion, when interest rates are high, the demand will be low. And if the demand is low, the income will be low. Correct? Aggregate income equals to aggregate output.
Yes.
So the conclusion is that at higher prices, the demand will be low. At lower prices, lower level of interest rates, there will be more and more demand. That's why demand curve is downward sloping. Clear? So until now, we have discussed more on the demand side. But what happens more on the supply side? Aggregate supply. Supply, we just discussed supply. Aggregate supply was who supplies? The producers, right?
Producers.
They supply. And what will be the aggregate supply? The supply of the overall economy. The aggregate supplies describes the relationship between the price level and the quantity of real GDP supplied. Means how much do you want to supply? First of all, the supply curve is always upward sloping or downward sloping? Upward sloping. And the supply curve depends on your factors of production. Do you recollect something that we discussed? What is long run and short run in economy? Economics. In short run, some of the factors of production are fixed, but in long run, everything is variable. So we will consider three different supply curves: very short run, and long run. Very short run means there is less scope for you to change something in the short run, right?
Yes.
So can you immediately in the very short run, can you increase the capacity? No. Many of your costs are fixed in the very short run. So can you immediately overnight increase the quantity? Probably very difficult. Were companies able to immediately produce masks and vaccines at the outbreak of pandemic?
No.
So what happens in the very short run? The firm adjusts the output without changing the price. They don't change the price by telling the workers to work more. Correct? And the intensity of use of plant and equipment in response to the changes in demand. Because in the very short run, if it's just a temporary spike, then I may not all of a sudden increase the capacity. Are you getting my point? I will tell my workers to work more initially. For example, let's say in your office, all of a sudden you've got one more extra project, which is for, let's say, 1 or 2 weeks. Will you hire an employee for that? Or will we all work more time to complete that project? We will do that, right?
Yes, we work more time.
Right. So basically we adjust output without actually incurring any extra cost or without changing any price. We represent this with perfectly elastic short-run supply curve. So the very short-run supply curve is perfectly elastic. Means in the short run, if you slightly also change the price, the quantity will become zero. So do you recollect the supply curve? When it is perfectly elastic, it is horizontal or vertical? The curve, when it is perfectly elastic, it is horizontal. See, when it is perfectly elastic, means even if I change the price,
it's horizontal.
The output will completely become zero. So there will be no change in the output. Okay. So the very short run supply curve is horizontal. Clear?
Yes.
Now, from the very short run, we will move to the short run. Short run supply curve is upward sloping. Why? Because some of the inputs can be now changed. At least some of the, not everything, but some of the inputs. Some inputs price will change as the production is increased or decreased and change proportionately to their price level. But there are still many input which are sticky. What do they mean by sticky? That they do not adjust to changes in price level in the short run. So in the short run, their prices will not change substantially. When the output prices increase, the price level increases, but firm sees no change in the input price in the short run. Firms respond by increasing output in anticipation of greater profits from higher output prices. The result is an upward sloping SRAS curve. What does it mean? That in the short run, what will happen? Not all your inputs. What are inputs, by the way? They are saying some input prices will change. For example,
The materials.
the materials price may change, but the labor price may still remain
Fixed.
constant, right?
Constant.
They may not change. So when you produce more, when the output increases, the price level will increase, correct? Because the raw material prices are increasing, but firm sees no change in the input prices in the short run. So there's not a substantial change in the prices of input because some of the inputs are still sticky, means their prices have not increased. So firms respond by increasing the output. So the firms will want to produce more and more. They would want to sell more and more so that they can get more profits. So what are they're trying to capture the profits, because they think that, with more and more demand, what is happening, they are ready to produce more. For example, let's say more and more work is coming, I will push that more and more on my existing employees so that I get more and more profit if I am an employer, correct?
Yes.
Now my supply, I would want to supply more and more at higher prices, correct? I would want to do more and more jobs for higher profits, clear? But then what will happen? So the short run supply curve is actually less elastic than the very short run supply, right? So it is, if you notice that is upward sloping. But in the long run, what will happen? All the costs can vary, and the long run curve is perfectly inelastic. What do you mean by perfectly inelastic? That even if you change the prices, there will be
no effect on demand.
No effect on the supply. Okay. In long run, the wages and the other inputs prices change proportionately to the price level. So now I will have to increase the salaries also, right? Because now more work is coming, the price levels are rising. So the price level has no longer an effect on aggregate supply. We refer to this level of output as potential GDP or full employment GDP. So in the very short run, what will happen? The supply will be perfectly elastic. And gradually it will become inelastic. And to a point in the long run, the supply curve will be perfectly inelastic, means it is not affected by the price level. This is very, very, very important. In the long run, the supply by the economy is perfectly inelastic. So whatever is the price, they are willing to supply the same quantity. Is that clear?
Yes.
Right? Even if the prices change, the quantity supplied will change or not change. It remains constant. This is called potential GDP or full employment GDP. This point is called potential GDP or full employment GDP. Very important point. Sorry. Potential GDP, or so you can write the long run supply curve, aggregate supply curve is a point which is perfectly, I will write LRAS is perfectly inelastic, and this point is called potential GDP or full employment GDP. Clear? Because GDP means entire output of the economy, right? The economy that it wants to produce or supply. Clear? This was very important to be discussed, that what is going to be the aggregate demand curve is downward sloping. It has an inverse relationship between price and income. Supply curve is, in the very short run, it is inelastic or elastic? Highly elastic. Then it becomes completely inelastic in the long run. Correct? So now tell me one thing. What happens when there is a shift in the demand and supply? Now you think from the economy point of view. Now, without even reading a lot of things, tell me one thing. When there is an increase in demand, will it go on the right or on the left? The demand curve is downward sloping. At the same price, when let's say at AD1, this is your output, right? When there is an increase in demand, what happens?
Goes to right.
Output will increase, so it will go to the right, isn't it?
Yes.
So if there is an increase in demand, the demand curve shifts on the right. But was there a change in the price?
No.
No, right? Now see, listen to this very carefully. Shift means increase or decrease, but no change in the price. So the aggregate demand curve reflects the total level of expenditures by consumers and all that. The number of factors that affect, okay. Note that a change in the price level is represented as a movement along the AD curve and not a shift. So see this. I'll repeat again. If at this point, this was the price and this was the quantity, if I now do one thing, that if I take a different price on the same AD curve, what has happened? The price has changed, right? On the same AD curve or on a different AD curve?
Same.
This is called movement along the AD curve, not the shift. So what happens in the movement? The price changes on the same AD curve. Are you getting my point?
Yes.
But what do you mean by shift? Shift means the price does not change, but the AD curve itself changes, which means the quantity will change. Is that clear? So there is a very big difference when we discuss what is the shift and what is the movement. So I want you to read this point, very, very important point. I want you to read the next 2 points, please, if you can read and connect what we just discussed.
Note that a change in the price level is represented as a movement along the AD curve, not a shift in the AD curve.
Correct. So when I say there is an increase in demand, which means there is a shift or a movement, there is a shift in the demand curve from, to the right. And when I say there is a decrease in the demand, it's on the left. Indicating that the quantity of goods and services demanded is greater at the same price level. So at the same price, the quantity demanded is greater. That's called shift. Clear? Now, why will the demand increase? To analyze the demand, what factors do I need to focus on? The GDP factors, which is C plus I plus G plus X minus M. Correct?
Yes.
Correct. Now, various components can be, focused on. Why would the demand increase? Because there is increase in consumers' wealth, business expectations, consumer expectations of future income. Maybe my future salaries will increase, so I'm spending more. High capacity utilization, expansionary monetary and fiscal policy means government is also spending more money so that people can demand more. Clear? Exchange rates are in your favor and the global economy is booming. All these factors will lead to shift in the demand curve. Clear?
Yes.
Now, what will lead to shift in the supply curve? First of all, do you see the supply curve? When it shifts, it goes at the same price, more and more quantity are supplied. Clear? Who supplies? The producers. So when I say the supply curve is shifting, it reflects the producer are supplying more, and they are supplying more because they are able to afford the factors of production, which is majorly capital and wages. So the short-run supply curve reflects the relationship between output and the price level when wages and other inputs are held constant. So assuming that there is no increase in your input cost, right? And you're supplying more at the same price level, that's called shift. The curve shows the total level of output that businesses are willing to supply at different price levels. How much you're willing to supply, that's the curve. But the shift is the increase in supply at the same price level. Clear?
Yes.
So an increase in aggregate supply is shown by a shift to the right. And what are the factors that producers are ready to supply more? Well, if they get the factors of production easily, they are ready to supply more, right? Because that's what the cost that they pay for. Clear? So what are the factors of production? Labor, capital, land, and all those factors, right? So see this. The number of factors that can cause a supply curve to shift to the right are labor productivity, means labor are able to generate more and more goods. Input prices are low. Expectations of future output prices, means you are able to sell goods at higher prices in the future. That will motivate you to supply more. Clear?
Yes.
Government taxes are going down or subsidies are increasing and the exchange rates are helping you. All these factors will be leading you to supply more. So tell me one thing, when there is increase in the demand, the AD curve shifts to the right or left? And the supply curve also shifts to the right. But we just discussed that the long run supply curve is ideally elastic or inelastic? Perfectly
Inelastic.
So now what about the shift in the long run aggregate supply curve? Again, if you see, the long run aggregate supply curve has also shifted, which is perfectly inelastic at the potential level of real GDP. So this is very interesting. We just discussed that this point is called potential or full employment GDP. So when will the full employment GDP increase? When the long run aggregate supply curve shifts. That time we say the potential GDP is increasing. Clear?
Yes.
So next time when they say that the LRAS is shifting to the right, that means the potential or the full employment GDP, the GDP at which that full employment is possible, full potential is possible of the economy, that has been increasing. Clear? And what are the factors? Again, the same factors of production. There is more increase in the supply of quality of labor. So the labor should also increase and the quality of labor should also increase. That same thing should happen from natural resources or from financial capital or physical capital and from technology. So in the long run, if your economy has to progress, what should happen? The supply and quality of labor should increase. Natural risk are increasing natural resources in your hand?
No.
Stock of physical capacity means investing more in capex. That's in your hand, right? You should invest more in plant and machinery. You should more invest in technology. Clear? And you should more invest in the quality of labor. Now, let me tell you, quality of labor, better capital, and better technology. All this comes when your population is skilled. Are you getting me? And for that, education is so essential, isn't it? Are you getting my point? Skill-based education is more important. Yes. If the population is not skilled enough, then it's waste. And having such a high population will not be fruitful. You need to have quality more than quantity. So do you recollect at the start of the session, somewhere I told you why Germany or Japan, what happened in their economy in those 20 years, why their economy boosted so heavily even after the two world wars that they faced? Well, they always focused on skill-based education. This is what my belief has been. They always focused on skill-based education. Okay. The same happened with South Korea. The same happened with China in the last 20, 30 years. They have focused on skill-based education. Their graduates know how to prepare financial statements. There, the kids in the vacation, they go into the school. What did you and I do in vacation? We went for holidays, right? Or we
Yes.
wasted our time, completely wasted our time I wasted my time playing cricket. I did not do anything productive. Okay. But in China and in many of these Southeast Asian nations, uh, the schools are open in the vacation also, where students are called back to get trained into softwares, hardwares, tools. All this is happening while they are still in the school. Okay, so by the time an engineer passes out from Chinese university and an engineer who passes out from Indian university, I'm not talking about the IITs, the best institute that we have. No. Otherwise, apart from that, our education system is completely theoretical only. The easiest example, which I have been saying everyone, is that you and I, we all have done graduation in commerce. We have prepared thousands of balance sheet in our 5 to 6 years of graduation, but not once we have seen real balance sheets of any companies, isn't it?
Yes.
That's such an irony. Why were we not once showed that how does an actual balance sheet of a bank or a big manufacturing company looks like? Why did they never showed us that? That's what my question to all the education institutes in India is. How can you just tell me to do something and not show me how it works? That's the reason why even after graduation, if you are not doing accountancy course, it's so difficult for you and me to, prepare a balance sheet. Our entire focus on the balance sheet was just somehow it should get tally. So we were thinking mathematics when we were doing accounting, isn't it? So my conclusion is that in the long run, if the economy has to grow, it has to focus on these long-term aspects: the quality of labor, the natural resources, physical capital, and technology. China is focusing on all of them at once. Now you may be wondering, sir, I understand labor, capital, and technology, but how natural resources? Well, China is going all around the world to acquire assets which has huge natural resources, whether that's in the sea, the South China Sea, whether that's in the oil fields in the Middle East or Africa, whether that's in the Central Asia with regards to Afghanistan, infrastructure in Pakistan. China is being everywhere in terms of doing infra development in those countries and getting the natural resources. China is doing, it's actually ticking on all the boxes that a country has to grow for, by hook or by crook. That's what China is doing. Got my point? Yes. So I don't honestly think Chinese, they may be our enemies on the borders, but I think there's always something to be learned from enemies, and Chinese have done anything and everything to ensure that that country is at top. That passion is worth commending, and they've proved that in the last 2 decades from where they've come and where they've reached. So that's a tremendous thing. Clear? This is all shift in the demand and supply curve. Clear?
Yes.
Now, movement, as I said, is on the same demand and supply curve when the prices change. So in contrast to shift, aggregate demand and supply curve movements are the one where the curves reflect the impact of change in price on the quantity, demand, and supply. So it's due to the change in price. In shift, the price remains the same, the demand and quantity is changing. In movement, the demand and quantity moves with the same with different prices on the same curve. Clear? Correct?
Yes.
Now, what to make of all this thing? Well, I understood aggregate demand and supply. What to make of all this thing? What happens when they shift? So see this. Long run equilibrium. Long run equilibrium is the starting point. Basically, what is the base? The base, if you see, we just discussed the short run supply curve, upward sloping. The long run supply curve is inelastic, and the aggregate demand curve is downward sloping.
Downward sloping.
This is an ideal situation where the economy is at this point. This is potential or full GDP. This is the price level, right? This is the starting point where the economy in the long run should be. Equilibrium occurs when AD curve intersects the SRAS curve at point on the long run curve. Because equilibrium occurs at point long run aggregate supply curve, the economy is at potential GDP, both labor and capital are fully employed and everyone gets a job. So it's a full employment point. Clear? So in the long run, what is the situation? The potential GDP means what the GDP should be is where it is. And at this point, employment is full. Clear?
Yes.
Now, let's understand what happens one by one. For example, let's understand if I increase the demand curve or decrease the demand curve. First, let's say decrease the demand curve. So without I making you see anything, if I've increased the demand curve, shifts on the right, decrease goes on the left. So with the decrease in demand curve, what has happened? What has happened? Prices have what?
Increase.
Are you sure increased? See the
So
AD1.
P1 here decrease. P1 to P2 decrease.
This is the point, right? Initially, this is point 1. Then the demand curve has only shifted here. Correct? So the demand curve has shifted on the same. So the prices have gone down and the level of GDP has also gone down.
Down.
Yes or no?
Yes.
So the prices are going down and the GDP is also going down. This is called recession. Recessionary gap. It is when there is a decrease in demand. There is a recession, decrease in demand. It's a situation of declining GDP, and what will happen to the unemployment? Unemployment will increase. Yes or no?
Yes.
So is the GDP at full point or full potential or less than potential? Less than potential. Therefore, the unemployment will also increase. This is called recessionary gap, and recessionary gap is due to
Decrease in the demand.
Decrease in demand. Now tell me, at the same point, if I keep the demand constant and increase the if I keep the supply constant and increase the demand on the right, then what will happen? See this. Very interesting. First, what happened? The demand curve moved from point A to point 1 to point 2. So initially we were at this point, correct? You see that?
Yes.
Then when the demand increased, the price and the quantity both increased. Price and the quantity
Increase.
both increased. Correct? So the inflation also, you can say, increased and the GDP also increased. Clear? But you know, with this, there will be more. We understood in microeconomics also, there will be more. What will happen? Eventually, more players will come in. If there is more potential GDP, there will be more. If there is more supply, more demand in the economy, more players will come in, right? In the perfect competition, if you recollect.
Yes.
So then, what will happen? The supply curve. What has happened to the supply curve? Ideally, the supply should also increase, right?
Yes.
But Contrary to that, what has happened to the supply curve? The supply curve has reduced.
Reduced.
That. So then if the supply curve has reduced instead of increasing, what has happened? The prices have increased at the same quantity. So the GDP has come back to the same point from Y1 to Y2 to Y3, but the new price is very high. So has the GDP increased overall?
No.
No. For the GDP to come back to the equilibrium point, but what has happened to the price? The prices have increased. So due to the increase in demand at the same supply, if just imagine if more people are demanding this pen and the supply is limited, what will happen to the price of pen?
It will increase.
It will increase, right? This is
Yes.
called inflationary gap. So recessionary gap is when there is a decrease in demand.
Demand.
Inflationary gap is when there is an increase in demand. Clear? Now just imagine a situation where the demand curve is at the same point and the supply has increased or supply has decreased. That's what we will understand. So the first situation we understand is when the supply is decreased. So the demand was same, but all of a sudden there is some issue due to which the supplies have become less. What happened? The price is also high and the economy is not at full point of GDP, right? What is happening here? Is the GDP increasing or decreasing?
Decreasing.
Decreasing. And the inflation is
Increasing.
increasing. Now, see this. In the previous two cases, when I changed the demand, aggregate demand, the inflation also went down, the GDP also went down in recession, right? In inflation, the GDP was at the same point, the inflation increased in the inflationary gap, right?
Yes.
But the worst situation is when the price inflation is also increasing and GDP is also falling. This is called stagflation. Stagflation is a situation where the economy is stagnant or falling and the prices are rising. This happened with the US in 1979-80 when there was an oil embargo and OPEC had stopped the oil production. They had controlled the oil production and then the oil prices doubled. So US economy's GDP was falling and the inflation was very high. Got my point?
Yes.
So that was due to various reasons, including the war in the Middle East, the Iran-Iraq war, which lasted for 10 years. So for 10 years, US almost faced a situation where its GDP was
Down.
falling.
Falling.
And inflation was
Increasing.
increasing. So can you tell me what should be the solution here? What should I do?
Government should intervene.
Intervene and increase the supply, correct?
Yes.
If you increase the supply, what will happen?
There will be more money in the
Supply
market.
will no. Increase the supply of goods. What will happen? The supply will come back to this point and the prices will reduce and the quantity will increase, right?
Yes.
So in order to come back, you have to release the supply, right? What US did, let me tell you something, and this is out of syllabus, okay? US realized that I have to break this supply chain, which is not in my control. And the only way to do is that to enter into the war in the Middle East. And US entered into war so that it can control the supply. Why? It was more of an economic decision, not an emotional or religious decision. So that the prices go down and the GDP increase. Are you getting my point? That was the sole reason of the Iraq wars that US did. Are you getting my point? Clear?
Yes.
This is called a stagflation. US wanted to come out of stagflation. It had no choice but to break the supply by entering into the Middle East. So the OPEC, which was so powerful and had become independent, went at the mercy of US, because US said that in the name of terrorism, I will do wars. And then, are you with me or are you against me? If you are with me, help me. If you are against me, war will be on you. So the entire war in the Gulf has been to shift the supply curve back. Got it?
Yes.
So that's a stagflation situation. Now, if there is an increase in supply, just see if the supply increased. Initially, it was at this point, and then I just increase the supply, right? Then what has happened? The prices have also come down and the GDP has also increased. This will happen when are you able to increase the supply at the same demand? Do you notice that? At the same demand, you are increasing the supply, then the prices have also gone down and the GDP has also increased for the short run. This will happen when the cost for production is very low, when the input cost is low. So this is called a situation where there is a decrease in input price. If there is a decrease in input price, I will be able to supply more. Clear?
Yes.
So for the short run, your economy will be above the full employment GDP. Is that clear? Now, I know a lot of times, we get confused at what all things we have done. There is so much of things that we understood. So now see everything from one point of view. Here, I either change the demand curve. I shifted the demand curve or the supply curve, not both. I shifted either the demand curve or the supply curve, correct? So just imagine when the demand is decreased, what happens? There is a recession, correct? And in recession, the GDP will increase or decrease?
Decrease.
Decrease. Price level will?
Decrease.
Price level, sorry, yeah, my mistake. Price level will also decrease. That's what happened, right?
Yes.
Here in the first part, the price also decreased and GDP also decreased. And if the GDP is decreasing, what will happen? Unemployment will increase. On the contrary, when I increase the demand, the real GDP will increase. The price level will also increase and the unemployment will temporarily go down. Now, supply curve. When there is a short in the supply, the US war situation, what happens to the real GDP? Decrease. Prices will increase. That's the worst situation. And unemployment will also
Increase.
This is the situation that US was into, and it had no choice but to go for a war to break the supply constraints, right? However, when there is an increase in supply due to the cost of inputs going down, the real GDP, yes, will increase. The price level, which we saw here, the price level went
down.
Decrease. This is the best situation, right? And the unemployment will also decrease. These are short-term effects of either shift in the demand or the supply curve. Correct? Everyone? But here, if you notice, I just changed one of the factors, either the demand or the supply. I did not change both together. Correct? Yes? But what if I change both together? So we are now understanding the effects of combined changes in aggregate supply and demand. See this. In this part, I change the demand. Also, I increase both, right? See that. I increase the demand and I increase the supply. Correct? what has happened? From what was the basic point? The basic point is this. Clear? From that, what has happened now? What has happened? Can you?
GDP has increased.
The GDP has increased, correct? And what about the price? Is the price actually increased, decrease? First of all, tell me if the demand increases. Just ignore everything. Take it individually. If the demand increases, the price should actually increase, right?
Yes.
Just see the demand curve. At the same supply, it should be here, right? Correct?
Yes.
So if the demand increases, price should
increase.
But if the supply increases at the same demand, if the supply increases at the same demand, then what should happen? See that. I increase the supply at the same demand. You supply more at the same demand. The price should come down or increase?
Come down.
So the situation is that when both demand and supply curve are increased, the GDP will increase. The GDP will increase, but the price level, the inflation is uncertain. It depends. Depends which factor affects more. Are you getting my point?
Yeah.
Huh?
Yes.
Why? Why? Because I'm not sure which factor is affecting more. Is the demand affecting more or the supply? So I'm not certain about the price level. Clear? But the GDP will increase when I increase both. Correct? Now see the same when I decrease both. What happens when I decrease both? The demand is going down. The supply is going, both are going on the left, right? Correct? What happened here? Just imagine if the demand is falling. If the demand is falling, from this level to the next level, the prices should fall, right?
Fall.
But if the supply is also falling, then the prices should rise. So again, when both are falling, is the price level certain or uncertain?
Uncertain.
Uncertain. But the real GDP will decrease. Correct?
Yes.
Now just see, there is opposite change in demand and supply. For example, in the section C, what do you notice? That the demand is increasing and the supply is decreasing. Do you notice that?
Yes.
So from this point, you basically reach to this point. What happened to the GDP? As the GDP actually increase or decrease? We don't know. Probably it's near the same point, right? But what happened to the price? What happened to the price?
Price increased.
Yes, because the demand has increased, supply has reduced, definitely the price has increased, but we don't know about the GDP. The GDP may or may not increase. That depends on, that depends on what? Which factor is affecting more? Either the demand is more or the supply is, if the demand is more and the supply has not fallen more, then the GDP may rise or may even fall. That is uncertain. Clear?
Yes.
So overall price level will, when the demand is increasing and the supply is decreasing, price level will increase. So same way now, when the supply is more and the demand is less, price level should decrease, but the GDP is depends. We don't know what will be the situation of GDP. Clear?
Yes.
This is, so there is more uncertainty when both get influenced, when both get changed, when both shift. Correct? This table will be very easy to recollect when you just look at the diagrams. In fact, you can plot the diagram and just see the change. Wherever if both the supply and demand curves both are changing, then either the GDP or the price level is uncertain. Clear?
Yes.
So what do you want? Do you want a growth in the GDP? Yes, we do want a growth in GDP, but we want a sustainable growth in GDP, not something which is short term. We want a constant growth in GDP. And that can happen, as I said, only if there is an improvement in the factors of production. Okay. Out of these many factors of production, if you recollect from the start of the economics, the two major factors of production which we focus on is
Labor and capital.
And capital, correct? Basically not the human capital, but the physical capital. So one way to view potential GDP is with the following equation: number of hours of labor which are working and the labor productivity. That's the potential GDP. So we focus on the labor point of view. What is aggregate hours work and the labor productivity? Aggregate hours work means how many hours of labor is being employed and how better are they improving their efficiency. The more better they can, the better will be the potential GDP. Now, this is in terms of dollar amount. In terms of growth, growth in potential GDP means growth in hours. Now, growth in hours is possible only when growth in labor force. You cannot increase the hours. There are only 24 hours in the day, right? So how can you increase the growth in the hours worked by if there is a growth in labor force and growth in labor productivity? Means, can I tell you something? The GDP can grow with two things. If the labor force is increasing and combine that with, yes, productivity. I just discussed your productivity is due to skill and education, right?
Yes.
And to increase the labor force, that's just increase in population. What is happening with China? China's population also increased. Its productivity also increased. Now India's population is increasing, no doubt. But if our population becomes more and more skilled, then this growth in population will not be a taboo. It will be a benefit. It will grow our GDP. Clear? So the only thing lacking for India is to increase the skill-based education. That will ensure that this additional population will also generate better GDP. Clear? The GDP growth rate will increase. Is that clear?
Yes.
So an economic sustainable growth can be estimated by the growth in the labor force and the growth in the labor productivity. So I've given an example. For example, India's labor force is projected to be increased by 5%, whereas its labor productivity is expected to grow by 2%. So I can say that India's potential GDP will grow by 7%. A simple math. Correct? Now, if your GDP is growing by 7%, this is your sustainable growth rate. Do you remember this sustainable growth rate in equity? Equity, yes. G, Gordon's growth rate G, which is ROE into retention ratio.
Retention ratio, yes.
So if the G is increasing of the economy, right, what will happen to the price of the equity? The price will increase. So when the sustainable rate of the economic growth is important, why? Because the long-term equity returns are highly dependent on the economic growth over time. So in the Gordon's growth rate, where P0 equals to D1 over KE minus G, here that G came from the long-term growth rate, which came from the growth in economy. So if there was high growth in economy, then the equity prices or markets will rise. Got it? So country's sustainable rate of economic growth rate is the rate of increase in the economic productive capacity or the GDP. And due to this, the value of the stocks will also increase. Clear? Yes.
Yes.
So as I said, two factors of production that we focus for economic growth, and that's what makes a production function. So production function is based on two factors, that is size of labor force and capital, right? But that is multiplied with one thing, that is A. A is nothing but the factor productivity. Productivity, I'll come to that, what exactly it is. But what is production function? Production function means what? It's a function like a linear regression equation. It tells you that what will be the economic output. It depends on how much is the labor, how much is the capital, and how well that is utilized. How well it is utilized, that is A, total factor productivity. So the production function describes the relationship of output to the size of labor force, capital, and productivity. Economic output can be thought as a function of all of these. Now here, the productivity is dependent on something that they call as technology. Productivity means based on technology. So is India technologically getting advanced? Yes. If you are getting technologically advanced with IT solutions, with the same labor, you can produce more and more goods. That's called productivity. With the same capital, you can generate more things. That is called productivity. So when I say total factor productivity, right, that A is nothing but total factor productivity, which quantifies the amount of output growth that is not explained by size of force and capital. So any growth which is not explained by the increase in population or capital, that comes due to technology. That's efficiency. Clear? Now, if I convert all this into per worker basis, so what will I do? Y, that is output per worker, is equal to capital and labor ratio. It makes the ratio of capital to labor, because everything I've converted into per worker. Now, what do you basically mean by this? The relationship suggests that labor productivity can be increased by either improving the technology, that is A, this part, or by increasing the physical capital per worker. Means, let's say, that there is an Indian army on the borders. I have 1 million army. Okay. And I have 10 million enemies on the other end. How can I now counter that? Either you bring some technology like drones to kill your enemy, right? Correct. Or what can you do? Or you can give more bullets or more high-tech equipments to your army to fight the enemy, right? Clear? Only then I can counter this huge enemy, isn't it, everyone? Are you getting my point? So two things for you to counter or to increase your potential is either improve the technology or give more capital for every labor. Per unit of labor, there should be more capital. Now, what is the thing that rich nations do? They have enough money, correct? So they can put more and more capital per labor, right? But they have to equivalently invest in technology. So they need those scientists and doctors and all those people, right? Engineers and all, right?
Yeah.
Now, if they don't have those, what do they do? What do rich nations do? They invite. That's called the immigration policy, right? They invite talent from abroad. Clear?
Yes.
This is what rich nations like Canada, Australia, Europe, US, they do regularly. They keep that open door policy so that they get quality labor, which can bring up the technology, because the capital, that is what they have. They need technology. And for that, they are willing to openly invite and give citizenship to, talented people. Got my point?
Yes.
So we assume the production function exhibits diminishing marginal productivity for each individual input, meaning that the amount of additional output produced by each input will decline, right? The more and more labor you employ, we understood that the marginal revenue will come down. That's called diminishing marginal utility. For this reason, for sustainable long-term growth, it cannot be necessarily be achieved by simply capital deepening investment. So just by having more and more capital, can you increase the growth?
No.
No, the rich nation, they have enough money, but they cannot just with that money itself, they can produce machines and all, but they need constant upliftment in the technology to be ahead. Clear? Therefore, just by increasing your physical capacity or capital, you will not grow. Productivity gains and growth in the labor force are also necessary for long-term sustainable growth. So technology and productivity of labor, the skill. So technology and education are equally essential for your long-term growth. So only by making money will you grow? No. You have to consistently invest in technology and education. Are you getting my point? Clear?
Yes.
That's why a lot of people telling me that, what's the point of going on space? It's such a waste program by Elon Musk or Richard Branson or, now Jeff Bezos. It's a waste concept, right? I don't think so. I think financially it may sound waste now. Like, what's the point of going on the, it's not an affordable business also and all. But just imagine the technological innovation that we are creating with that. That's something that takes US way ahead of all other nations. It does not spend always from the profit motive. It spends from something very, innovative, which gives a path to the world. That's what this is the best thing that I appreciate in US. It doesn't hesitate from taking challenges. And that's the same genes in the US nationals. That they just want to do something, not because it's profitably feasible or not. Got it? So I somehow see the US mentality as completely different with this. Clear? So what do we make out? That technological advancement and skill or education. Now, these are not the words used in economic. We use that as productivity. Productivity is essential for growth. Only capital is not enough for sustainable growth. Correct?
Yes.
So now we come to the conclusion that the growth comes basically from three sections: technology, labor, and capital. That will grow the economy. That will grow the potential GDP. This is also called the solo model or the neoclassical model, where the contribution of all three, technology, labor, and capital, leads to growth in GDP. Clear?
Yes.
Here, labor and capital, labor's percentage share of national income and capital's percentage share of national income. That is, how much is labor's contribution in GDP and capital's contribution in GDP, that is WL and WC. For example, if WL is 0.7, that means your economy is more dependent on labor than capital. Clear? Are you getting my point? That means labor's productivity is much better for your economy than capital. That's what it sounds like. Again, the multiplier here, the technology basically represents the total factor productivity, the growth of output that is not explained by labor and capital. So I've given here an example. Suppose there is a country whose WL is 0.7 and WC is 0.3. What does it mean? That if there is a 1% increase in labor force and if there is 1% increase in capital, what will affect the GDP more? What will make the GDP run faster? The labor or the capital? Very easy.
Labor,
right? So here a 1% increase in labor force will lead to a much greater increase in the GDP than the increase in capital stock because mine is more on labor oriented economy. Similarly, sustained growth of labor force will result in greater economic growth over time than the sustained growth of capital. So basically this WL and WC, which are the growth and the labor percentage contribution in your economy. For example, Indian economy is more labor oriented, correct? So the more increase in the labor force and labor productivity will increase India's GDP than more of capital. Clear? Correct. Sometimes the relation between potential GDP improvement in technologies and capital growth is written off on a per capita basis. So when I make this relationship on per capita means per person, right? So along with the growth in technology, the growth in labor and capital is converted into a ratio, which is a capital to labor ratio. Now, what does this mean? If WC is 0.25, what does it mean? That if there is 1% increase in capital per labor, will increase to the GDP per worker by how much percentage? It's like a beta. So if there is 1% increase in capital, I give more and more machines to every employee, right? If there is 1% increase in that, the GDP will increase by 0.25% GDP per worker. Okay. So if I give more capital to every worker, their contribution to the GDP will increase by this factor, WC factor, which is 0.25. Clear?
Yes.
So in developed economies like US and Europe, where capital per worker is already high, means this WC factor is already high. So what should I do? Capital per worker is already enough. I cannot give now more capital to increase the GDP. So what should I do?
Increase the technology.
The other factor, which is technology. So the growth of technology will be the primary source of GDP per worker. Clear? So these rich nations are already exhausted with high capital per labor. Now they have to increase the labor, or they have to focus more and more on the technological innovations. Clear? At higher levels of capital per worker. Why? Because the more and more capital you give, there is diminishing marginal utility. It will not help more in the increasing of GDP, but then advances in technology will lead to a growth in economy. Clear?
Yeah.
So overall, after a point of time, capital per labor will have diminishing returns. So it is then you move to the factor A, that is technology will be the prime factor for your future growth. That's the concept. So the productivity, the total factor productivity is a combination of three things: technology, capital, and labor. But capital and labor have diminishing marginal returns. So therefore, technology should also consistently increase. Clear? Yes?
Yes.
Well, this is a very lengthy topic, and each and every point I've explained in too much detail. Normally people just explain it on the upper view, but I've covered up everything here. So just revise it once. And this is where macroeconomic actually begins. So this is, as per me, this is one of the difficult topics. Otherwise, the other topics are lengthy but not difficult, because inflation, employment, macroeconomy, monetary and fiscal policy, currency, these are many of these terms which are going to come in the next readings. We have already, we already read that very often when we are related to financial markets or commerce. So that's not going to be difficult. The other readings are not going to be difficult. This reading is perhaps one of the most, I personally think, is difficult and lengthy. So once you now read it again with this explanation, it will be logically clear. But don't keep the pressure of, oh, I have to remember so many things. That will not help in economics and ethics. In these two topics, This strategy won't help that I have to memorize. No, that won't help here. You have to read it once or twice to dwell in it. Okay, so revise it before we meet to the next topic. Clear?
Yes.
So any doubts till this point, let me know, or else we'll connect in the next section. Clear?
Yeah, so far no doubts.
No problem. So that's it for the day, and we'll meet in the next section. Okay?
Yes. Okay.
Yeah. Bye-bye.
Yes, thank you.
Yeah, bye.